mind in 2026. As we wrap up 2025, everyone's watching Bitcoin prices, but the real story, the one that could cost you thousands, is happening behind the scenes. Governments all over the world are finalizing their crypto tax rules and data sharing systems. This isn't just a story for one country. It's a global transition year for crypto taxation. Let's break down what's happening so you can avoid penalties, audits, or a frozen account next year. For years, crypto was seen as a digital experiment, a commodity, something regulators would figure out later. But that era is over. By 2025, regulators from the EU, the UK, the US, and across the Asia-Pacific all agreed crypto is a financial asset, not a hobby. It's now being placed under formal tax regimes, just like stocks, ETFs, and mutual funds. This means reporting requirements, traceable transactions, and asset declarations are the new normal. So, why is everyone suddenly talking about tax reports? Here's why it matters everywhere. Exchanges are now legally required to automatically share your user data with tax authorities. This includes your transaction history, your balances, and your realized gains. It applies to both local regulated exchanges and major global platforms. This means if you traded on a compliant exchange, your government probably already has your data. If your tax report is missing or incorrect, it can trigger automated tax letters, audits, and penalties. It's no longer about getting away with it. It's about making sure your report matches what they already know. But don't panic. The rules are stricter, but they are manageable. Here's your global survival guide. First, download your complete transaction history from your exchanges. Use their built-in tax report or transaction export feature and do this before the year ends, not months later. Second, declare your year-end holdings. Most countries now want to know the value of your crypto as of December 31st, even if you didn't sell. This is for asset declaration, not necessarily an immediate tax payment. Finally, understand the difference between tax withholding and tax reporting. In many places, taxes might already be deducted when you trade. Reporting is just you confirming, yes, I've already paid this. Transparency is the main goal. I know, taxes are annoying. But this is actually great news for crypto. Why? Because now crypto is regulated, classified, and legally recognized. This means banks can offer custody, insurance funds can invest, and huge pension and institutional money can finally enter the market. This is how real, sustainable liquidity is built. Historically, regulation leads to legitimacy. Legitimacy brings in institutions, and institutions fuel long-term bull cycles. So, the main takeaway for 2025 isn't about price hype. It's about compliance and preparation. Most tax problems aren't from fraud, they're from missing data, procrastination, and that "I'll fix it later" mindset. Fixing your records now means zero stress and a clean portfolio for 2026. Whether you're in Asia, Europe, or the Americas, download your reports, check your balances, and stay aligned. The next bull run will reward the prepared investors, not the careless ones. Thanks for watching, and don't forget to subscribe for more essential crypto insights.